Welcome back to another episode of Investing Explained. Here's today's question.
Okay, so I think it's important for people to first start off with the idea that if you do have a flat bond yield curve, it doesn't necessarily mean that you're going to have a recession right then and there. I think you could go back in the time and see different periods where the bond yield curve was flat and the market continued to run for a year to 3 years when it was in that condition. It's one point that you need to look at in an array of many points to try to understand where you're at in a credit cycle. Now, think of it from a business's perspective. If you're a small business and now the rate that you have to lend or borrow money, and businesses are highly reliant on short-term borrowing. So they need to go out, they need to borrow money in order to pay for a bill, and then they pay that off 30 days later or 60 days later or whatever. And so this short-term lending market is very, very important to small businesses. And so if you're a small business and all of a sudden that short-term borrowing interest rate becomes higher than the interest rate on long-dated debt, that starts to cause a lot of problems, because for you as a business, when you look at your income statement and you got your top line and then you got all of your expenses and then you get your bottom line, those expenses and your interest expenses are going to start going up way higher than where they were before as all these interest rates start going higher. This is typically an indicator of the market is pricing the out years, the growth expectations, far worse than what you are currently experiencing. That's what that inversion is actually kind of showing you. It's just something that when you go back into history, you look at what kind of precedes and then follows these inversions in the bond yield curve. They typically are kind of a canary in the coal mine that, there's going to be troubles on the horizon. And so we're seeing that today in 2018. We are seeing the start of a flattening of the bond yield curve. I would not call it inverted at this point because the short-term yields are definitely still lower than the long-term yields, but they're coming up aggressively and it's starting to flatten out. There was a brief period of time where in the middle of the bond yield curve, there was an inversion, but it wasn't a complete inversion like we've seen in the past. So that's just a data point. That's something for people to think about.
And another thing to add to this is also at this point in time where it typically happens, you see that the debt that needs to be serviced grows faster than the income in the economy. What you basically do whenever you have a flat or inverted yield curve is that you incentivize people to move to cash, or if not cash, then just tie your cash into instruments for a very short period of time, which is as good as cash when something happens. And what really happens is that you are taking money out of the system. You are indirectly seeing a tightening of credit. So you are more prone to see a bubble pop at that point in time. I just want to add that as a piece of context to understand what's going on in the financial markets, because you would need to sell your financial assets to service that debt.
Everything leading up to this flattening to inversion in the bond yield curve is expansion. You have credit expansion. You have people's income levels going up as a function of all of this. And so more people have money, they're able to spend, and it gets into this whole Ray Dalio description of how credit cycles work. When you're at this point, what Stig was just describing is really that transition point where you start getting into the self-reinforcing in the opposite direction, where tightening is occurring and there's less money, there's lower incomes, but yet those debt service levels, those interest levels are now exceeding the income levels, which further compounds the cycle and causes it to strengthen as it continues to go down. I look at it as a great way to kind of understand where you're at in the credit cycle and kind of understanding when you're kind of hitting a top. I would say that you're starting to see that now.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.